All right, I think we're ready to get started for the deep dive this morning. I just want to say welcome to everybody that's joining. With a countdown, we get people on ahead of time before the top of the hour here. It's 11 o'clock on the East Coast, 8 o'clock in the Pacific. And let us know where you're watching from. It's always so good to see people from across the country starting their week off with the deep dive, where we're going to talk about what's most important, and that's mortgage rates. Today, certainly seeing a lot happening right now and the end of last week. So we're going to cover that and talk about that. And here's what sort of the perspective that I would take right now, or even what we're going to spend the next few minutes on, is where are we at right now, but more importantly, what's ahead for this market. I think that's the thing that maybe many of us are wondering. Certainly, those thinking about buying homes, this is beneficial for them. The drop in mortgage rates helps them with the affordability of a home right now. So that is a good thing. But there are other things going on in the market. I'm going to watch here as folks are joining. And again, let us know where you are watching from. And if you know somebody that needs to, get this information, maybe another agent, share this with somebody that that could benefit from getting that information. So seeing everybody on here, Kim, see you in Greenville, Ken, see you there in San Pedro, Candace in Nashville. Great to see everybody on. I know others are joining right now. And again, we're going to talk about mortgage rates, a little bit of news on that, a little bit of action that's very advantageous. And I'm going to break down why that's happening and what's ahead, like I mentioned. So with that as a backdrop, I'm going to go ahead and share my screen. We've got new slides this morning, a new look. If you have joined the deep dive and you're familiar with our slides, our team has built a new deck, and Madison's done a phenomenal job. The entire team working hard to update things, to give you great graphics to be able to use in social posts, in maybe presentations, and buyer or seller presentations, however you see fit. If you're a KCM member, you can always go in and download these slides, and I want to encourage you to do that. But all of this information on mortgage rates comes out of the Fed's meeting last Wednesday, and in support of its goals, the committee decided to maintain the target range for the federal funds rate, 5.25% to 5.5%. So the Fed does nothing last week, but we see all of this action. Why is that? Well, maybe you're on the deep dive and you're like, I understand that, David. I know what's going on. If you're not, I'm going to give you some information on that. And even if you are, my encouragement to you would be really to pay attention on how I explain this, and pay attention to how you and the words you might use as you explain it to those that you're working with. So why did this sort of start to happen? Well, Mark Zandi said it best. He said the Federal Reserve stuck to the script, holding monetary policy unchanged, but strongly suggested a rate cut is likely in September. The inflation data must cooperate for the Fed to follow through, but all indications are that it will. So the Fed comes out and says, you know what, we're not going to cut the Fed funds rate right now. And that's not the same as the mortgage rate. It's different. But they said, okay, it's likely that they're going to cut the Fed funds rate in September. And you're certainly seeing the market react to that and some other things that are at play right now. We have talked about this, that the odds-on favorite, for the last month or so by Wall Street is that there would be a Fed cut in the month of September. There was actually a poll done by Reuters as well in the last month that most economists believe the Fed will cut rates 2 times this year. Now that could jump up to 3. Any of this information could change, based on what happens in the economy. But we're starting to see this path forward of when the Fed may take action. I want to keep going here. Sam Cater from Freddie Mac, he said this: mortgage rates declined to their lowest level since early February. Expectations of a Fed rate cut coupled with signs of cooling inflation bode well for the market. But apprehension and consumer confidence may prevent an immediate uptick, that's in transactions, as affordability challenges remain top of mind. Despite this, a recent moderation in home price growth and increases in housing inventory are a welcome sign for potential buyers. Now, I'm going to get into this in just a minute, but as mortgage rates come down, it helps with affordability. We've talked about the things that influence that: wages, what people are earning. We've talked about the price of homes and mortgage rates. What it costs to finance a home. And this drop in mortgage rates over the last several days coming out of the Fed's meeting certainly helps with that. The other thing that's at play right now is unemployment. That is weighing into this. The unemployment rate rose by 0.2 percentage point to 4.3% in July, and the number of unemployed people increased by 352,000 to 7.2 million. These measures are higher than a year ago when the jobless rate was 3.5% and the number of unemployed people was 5.9 million. So as you think about this, Fed, says we're not going to cut the Fed funds rate, but likely to in September. Unemployment comes out a little bit higher, and to give you a graphic look, this is a look at unemployment going all the way back to, kind of the pandemic. The red bars there on the left, you see are during the pandemic when unemployment shot up and started to come out and plateau and ever so slightly come up, sort of causing people to wonder, okay, what's going on in this economy? What's happening? And certainly we're seeing the reaction last week in the stock market. We're seeing the reaction this morning in the stock market. If you've been following the 10-year Treasury, it's come way down. We've talked extensively about that on the deep dive. And if you're a KCM member, you understand the relationship between the 30-year fixed mortgage and the 10-year Treasury. But all of these things weighing on the reality of mortgage rates and where they've been. Lawrence Yun said mortgage rates are plunging on the news of weak job growth, rising unemployment, and I would add to that what the Fed said about their rate cut. So what does this look like? I've got a couple graphics for you. Certainly if you are a KCM member, I want you to go in and download these. If you or somebody just watching, take a picture of these, share these, tag KCM, because this is the sort of visual of what's happened with mortgage rates in the last couple of days, end of last week. Right here, this goes back to the sort of the end of April when rates were about 7.5%. Fast forward to Friday, rates closed out on Mortgage News Daily at 6.4% on the average 30-year fixed in this country. So, better than a 1 percentage point drop from where we saw just a few months ago, and that is a very, very good thing. This has a very real monetary impact for people that are thinking about buying homes. If you look at this, if you take the average borrowed of this isn't the average, but if you take the an average of 500,000, if you're working in an area that's lower than that or maybe double that, you can do the math pretty quickly. Back in April, if you borrowed $500,000, 7.52, your mortgage payment just over $3,500. Well, that today, borrow $500,000, 6.4% monthly payment of just over $3,100, a savings of $357 just over the last several months. That is a good thing for anybody looking to buy. And again, if you work in an area that's maybe your average loan amount is $250,000 or maybe your average loan amount is $750,000 or $1 million, you can see the real impact that has on somebody thinking about going out and buying a home. We've got the tools for you inside KCM to help you showcase this and show people this is exactly what is happening in the market right now. And, inventory has risen over the last several months. And so now there are more opportunities for home buyers. And now it's gotten a little bit more affordable to go out and buy a home. Lawrence Yun said this, and I think he's right. There is a large pent-up stored demand that could be released into the marketplace when conditions improve, lower mortgage rates, and more inventory. Inventory is finally turning up about 15%, and that is likely an early leading indicator that we may finally see more home sales as conditions improve. No doubt with the fall in mortgage rates, inventory increasing, more people will get back into the market. Now, we're going to have to wait and see what's ahead. I talked about, the Fed saying, hey, we're likely to cut the Fed funds rate in September. Economists saying there's likely 2 Fed rate cuts this year. So we'll see what that means for the market. But no doubt that will mean that more people are able to buy a home as it becomes more affordable. And that is ultimately a good thing. Doug Duncan said this: listings have trended generally upward of late, suggesting that a rising number of current homeowners can no longer put off moving. I think that's the truth. A lot of people have put off the decision to move for reasons a lot, sort of centered on affordability. We did, a deep dive several months ago where we talked about the number of consumers that had abandoned their search based on mortgage rates. It was a study that came out of sort of the Mid-Atlantic here in consumers that said, "Hey, why did you abandon your search?" And they said it was because of price. It was because of mortgage rates. I think it was roughly 3 out of 4, about 70% of consumers said, we're not in. But there's still this reality this year of many people that have a preferred mortgage rate to say, we're gonna stay where we're at. There have been a lot of surveys, bank rates done several, that ask people, what would it take for you to get back in the market? And I'll show you this real quick. More than half of homeowners, these are people that say, here's where I would be comfortable buying. 52% said it'd need to be less than 6%. 47 said less than 5%. They could choose multiple options here. And still a contingent of people say there's not a rate that would make me comfortable. So it's going to be life events. It's going to be circumstances that cause people to make moves. But certainly with what we're seeing happening economically, certainly with what the Fed is saying, I think getting down in the low sixes or 6.4 right now, is not outside the realm of possibility right now. So I think there will be a lot of people that maybe put that consideration off that may now revisit it. What about those thinking about selling? What mortgage rate, if any, would you need to be comfortable with selling a home? You see, again, less there, but a rate less than 6%, 35% said they would be up for selling at that point. You see the rest there. And there's 42% that say we're good. We're not going to go anywhere. So certainly rates are going to have an impact. They're going to cause more people to look at the opportunity they may have to buy a home or sell their home. And look forward and maybe what they need based on what's happening in their life. There's nobody that's, going to have maybe another child and need more space. It's not going to make a move. There's certainly life circumstances, job moves, things like that cause people to move. And those will start to, influence how people buy and sell homes much, much more as we trail out this year. I want to spend just a couple minutes on what is ahead. I've got a few quotes here that I think give us sort of this pathway forward. And that's our job right now, is to help guide people forward on everything that is happening. Greg McBride with Bankrate, he said that the hopes for lower interest rates need the reality check that lower doesn't mean we're going back to 3% mortgage rates. Mortgage rates are 7% now when he wrote this, and the best we may be able to get back to over the next year is 5.5 to 6%. I certainly think that's within reason over the next year. We dip our toes into the 5, certainly seems very likely going into next year. Mortgage News Daily said it's very fair to ask where we go from here. There's never a crystal ball, and the lessons of early 2024 should be kept in mind. Additional improvement in rates will require a fresh supply of downbeat economic data, and there aren't many big ticket reports on the horizon. So what he's basically saying is that old statement, that bad news about the economy is ultimately good news for mortgage rates. Beyond the next 2 weeks, the next month and a half could be particularly volatile. I think that is absolutely true. We're going to see a lot of volatility. As it stands, the market is second guessing the Fed's decision to hold steady this week and wondering if they'll be playing catch up in mid-September in the event economic data keeps trending weaker. Many people, I'm certain you've seen it, many people calling right now saying the Fed should have made a move already, but they haven't. And I think we're going to see a volatile market relative to mortgage rates. I think this is a time for an agent watching. Having a great lender partner is key in this market. Having somebody that you trust that can help you guide your clients forward in an effective way, understanding what's happening, really seeing what's out there. Redfin came out and said this: for home buyers and sellers, today's data points to a more rapid pace of mortgage rate declines than previously expected. The daily average 30-year fixed mortgage rate fell from 6.62 to 6.4 following the release of the jobs report. However, economic data is always noisy, and this is only 1 month of data. The Fed will have a hard time looking past this, but they may want more solid evidence from another month of data to avoid panicking. So what you're seeing here very clearly, people that are following this market are saying, this is what's happening right now. Something different could happen tomorrow, and we'll have to wait and see. It's ultimately what economic data is going to tell us. But I'll tell you this, I think we can start to see everything that's happening and look forward in the next few months for mortgage rates to trend lower. I think that's a statement that we can make. It's certainly what forecasters are saying. It's certainly what those that are watching it. And I'll give you another. Bill McBride's phenomenal in watching the market. From Goldman Sachs, we now expect consecutive 25 basis point rate cuts in September, November, and December. The slowdown in job growth in the July report likely overstates the decline in the underlying trend. But if the August employment report is also weak, then a 50 basis cut would become more likely. So a lot happening there. But what the consensus is that you're seeing from these economists and these people that are, weighing in on the market is that watch for this thing to sort of trend lower relative to mortgage rates. Bank rate, one more here. If you're ready to buy, now might be the time to strike. Home prices have been rising primarily because of a longstanding shortage of homes for sale. That's unlikely to change. And if mortgage rates do fall below 6%, it's possible buyers would enter the market en masse, further pushing up home prices and resurrecting bidding wars. I absolutely agree with that. I think as you see rates trend lower, you'll see more activity in the market. That'll mean more upward pressure on prices, no doubt. We were talking the last several weeks about many coming out saying our prices coming down. There's certainly by market that's going to be something that you're going to watch. We're going to watch here at KCM. But if we start to see rates trending even lower, you're going to see more people back in the market, which means upward pressure on prices. I want to wrap up this deep dive. This is a topic that we're going to stay on top of, where our team is creating content right now for you to be able to share. If you're a KCM member, go in and grab this information, share it today, because people want to know. We do this deep dive every week because of this. Most of the agents out in the world know what's happening. Most people know what's happening with mortgage rates right now. It's everywhere in the news. The good agents understand it. But listen, if you're on the deep dive, great agents can explain what's happening. And my hope is that you'll take all this information and you're able to effectively explain that to your clients as we go throughout the fall. As many of them go, okay, it's now the time. Should we jump back into the market? You can be the knowledge broker that explains exactly what's happening. That's our goal. We'll be back next week. Kate will be on with our first part of a two-part series, getting ready for the fall. And we're really going to unpack everything happening with inventory. So we're going to stay on top of what's happening with mortgage rates. We're going to talk about inventory, give you all the information you need to be that trusted advisor for those that you serve. So as always, thank you for joining the deep dive. So good to see everybody on as always, and we'll see you again back next week. Take care.